In this week's video, we'll review the latest charts to help us answer the question, are there problems brewing below the surface for stock market bulls? Tweet from Thursday of this week said we've seen numerous examples of market hesitation. How concerning relative to all of the bullish evidence that we've covered since early April of this year. And as we proceed, it's always good to keep in mind, studies, charts, data sets, all of it helps us assess the probability of good things happening relative to the probability of bad things happening, which is significantly different from predicting or forecasting. Leveraged loans ETF chart dated closing prices Thursday, August 20th, 2020. This is one of many ways of looking at risk tolerance. From a price perspective, nothing too concerning, and if price moves in this direction, that would be good. From a bullish perspective, the further we move in this direction, the more concerning it would become, and we do have a little bit of a deteriorating profile from a volume perspective, but nothing all that alarming at this point. Dow Industrials, right now this looks like a breakout above this June high where my cursor is, and a successful retest as of Thursday's close. This gap in here is an important area to watch. We could learn something either way. And from a bearish perspective, we would learn something if we break this upward sloping trend line. It's still intact as of Thursday's close. And we would also be a little bit more concerned if we drop below the 61.8% retracement or if price moved in this direction. For the most part, this is a form of hesitation. From a longer-term trend perspective, nothing alarming on this chart yet. Same can be said for the NASDAQ that printed a new closing high on August 20th. From a reality perspective, it is not likely that a trend like this will stay in place. It is not likely that this trend line will be in place 6 to 12 months from now. At some point, we'll experience some type of give back. Hasn't happened yet. So weekly chart as of Thursday's close. This is an important chart. NASDAQ is the leader. NASDAQ 100 is the leader of the NASDAQ. QQQ relative to TLT. Rejected numerous times near the top of this box. We are trying to break out in a bullish manner. The longer this look holds, the more meaningful it becomes. It's good to keep in mind. A bullish breakout can turn into a failed bullish breakout. Here's an example of a failed bearish breakdown. We broke below the red box here and then reversed. Like many of the charts that we will cover in this week's video, we will learn something either way. Right now, this looks constructive as of Thursday's close. Back to the bullish evidence. 10-day breakaway momentum thrust that we covered on June 5th. Historically, really good things happen in the S&P 500 looking out 1 year to 5 years typically. And back in June, we also covered the maximum 6-month drawdown in each case. And on June 12th, we said if we're going to accept the green table from a probability perspective, we also have to accept the maximum drawdowns from a probability perspective. In the historical case, the maximum 6-month drawdown was 10.63%, telling us even under bullish circumstances historically, the S&P 500 could fall all the way back to 2791. Since the drawdowns are calculated from the date of the signal, this is still relevant today. And since on August 20th of 2020, we're near a new high for the rally, every single drawdown chart that we've covered in recent weeks and months, we really haven't seen anything that's been violated yet. That's the good news. The bad news is many of these charts tell us that we could backtrack and still remain on track from a longer-term bullish perspective. It's important to keep in mind, a maximum 6-month drawdown says it's possible that the market can go up for 1 to 3 months and then come down to that level, telling us that all of the maximum drawdown charts that we've covered since the low, for the most part, are still in play. It's extremely healthy to acknowledge bearish evidence because it helps us remain open to a wide range of outcomes, from wildly bullish to wildly bearish. In recent weeks and months, we've covered a lot of topics over here on the wildly bullish end of the spectrum. How about over here? You can pause your video player, but this is stocks versus bonds, SPY, relative to TLT. 2016, we have a major low in February. Eventually, this ratio has a bullish breakout. We do not have that in the present day, and currently we have a downward sloping trend line that still, from a longer term perspective, favors TLT over SPY. This chart helps us keep an open mind about a wide range of outcomes. If we zoom in here, Q4 2018, bad things happen in the S&P 500 until the low on Christmas Eve. Here, Q1 of this year, we all know really bad things happened. While the S&P 500 has cleared these levels in isolation, this ratio has not. It's not necessarily a showstopper, but it's something that we have to acknowledge and monitor. And we do have hard data that tells us there's nothing wrong with nailing down some profits as long as we have concerning data. This chart, dated August 20th of this year, says we have hard evidence that helps us with the maximum flexibility topic. Maximum flexibility 100% of the time. Equal weight technology versus bonds. Here's the June high. The S&P 500 has exceeded the June high. The ratio has not. We will learn something either way. What once acted as support may now act as resistance. We're back in this general area. It's possible that this ratio would move back in this direction. Similar situation here, SPY relative to TLT, telling us to keep an open mind, especially in the short run. This looks like a bullish breakout, and now we're not so sure. If we move in this direction, that's a good sign. If we move in this direction, it helps with the open mind topic. Here's the March low. Equal weight tech outperformed the S&P 500. Now it's starting to wane a little bit. This is banks, KBE. Impressive volume here, not as impressive in recent weeks. This is the S&P 500 on the bottom. This is KBE here. And this will be true relative to numerous charts and ratios we cover. The S&P 500 has clearly exceeded the June high. Banks has not happened. This is a much lower high relative to the June high. Why is this important? It speaks to future economic expectations. Market participants are more confident about the economy opening up here than they are here. Interest rates, 10-year yield, telling us to keep an open mind about worse than expected outcomes. There's really no resolution here yet. But it's hard to make the argument at the present time that this chart supports the bullish case. Here's 10-year yields right here on March 23rd. Yields are lower today than they were on March 23rd. The good news is we're trying to break out above this downward sloping blue trend line. Stock market bulls would prefer to see this breakout hold. Similar concepts here. S&P 500 has easily taken out this June high. JNK relative to IEF, not yet. Stalling at the 61.8% retracement. Stalling doesn't necessarily mean reversing. Still may get a breakout here, we just don't have it yet. Thus, we learned something about bullish probabilities if JNK relative to IEF can get into the green box, and we learned something about bearish probabilities if we move into the orange box. This is JNK relative to IEF. Similar situation, except a little bit worse, JNK relative to TLT. The good news is this bullish move here, we've only retraced 38.2%. you could call this a normal retracement within the context of an uptrend. This is a sign of market hesitation. Bullish conviction is higher here than it is in the present day. Doesn't predict anything. We just like to see this chart and many of the others improve. One comment here, corporate bonds relative to treasuries. This is weekly MACD. You can see some signs of slowing momentum here. Slowing momentum doesn't necessarily mean doom for the ratio. But there's no question this look in the present day isn't as sound as it was back here. Talked a lot about we want to see the rally broaden out. It really hasn't happened in a decisive manner. This basically tells us that equal weight and SPY have basically had very, very similar performance since March. They've both done well, but this was more evidence of broadening out, and now we don't really have it. This is more like consolidation, still potentially constructive. And some of this over here, relative to this here, has also shown up in recent market breadth data. This is from Thursday's session. The S&P 500 was up, but these are not particularly impressive stats from a bullish conviction perspective. These stats may improve walking forward, they may get worse. Right now, the shorter-term trend is they've been getting worse. We'd like to see them improve. And relative to this chart here, it would be concerning if this ratio has a bearish breakdown. We would prefer to see it get up into this box, and it would be even better if we could exceed this high. Right now, we're really just consolidating. The look of this isn't particularly bullish or bearish right now. This box, and this box, all of it speaks to the concept of trading the charts in front of us. We're not predicting what's going to happen next. We're basically saying if we move down here, how would we handle that? If we move up here, how would we handle that? If we can answer both of those questions, we really don't need to predict anything. This is a monthly chart. It's only August 20th. This chart may look radically different on August 31st, but right now, this is a lower low. We prefer to see something like this. This is 2009. That may happen over the next 11 calendar days, but right now this is a concerning look. This is the chart in front of us today. Similar situation here, economically sensitive airlines relative to the S&P 500. Conviction today lower than conviction at the June high. This is another consolidation look, not particularly positive, not particularly bearish, but definitely not as bullish as this look here. Similar theme with small caps, mixed bag. This is still an upward sloping trend line relative to the S&P 500 since the March 23rd low. But here's the June high, and here's where we are today. This trend line holds and we exceed this high, we learn something. If we move down here, we learn something. Growth has been doing extremely well relative to the market. We don't really have evidence in hand. That's particularly concerning at this point. The ratio made a new closing high on August 20th. This is SCHG growth relative to TLT. You can see this here. This is a lower high here. This is a higher low. This is a breakout. A little bit of a hesitation here, but for the most part, this is a constructive looking chart. And if the market pulls back, it's possible that this area here could act as support for the ratio. This is diversified bonds, AGG, a basket of bonds in isolation. Similar situation. We're hugging this upward sloping trend line. Somewhat looks like a bearish break of it, but momentum's down here. Last time we got down here, we turned up. This is your hesitation or indecisive look. This is indecisive, but it doesn't look as good as this look here, so there is some deterioration. This is gold GLD in isolation. Nothing particularly alarming at this point. There's some deterioration, but we haven't even pulled back below the 38.2% retracement of this A to B move here. The Fed slope's still intact. Like every other chart, we'll learn something either way. For the most part, if you're bullish on asset prices, you would prefer to see this ratio hold this trend line. You definitely want it to hold this trend line, and you definitely want it to hold this bullish breakout. If it moves in this direction, you can make an argument it speaks to increasing inflation expectations. When it's moving in this direction, you can make an argument it speaks to increasing deflationary expectations. Deflation is typically not good for asset prices. Right now, this looks like a pullback. Gold and stocks can go up together, so this ratio here is more of an opportunity cost chart. Right now, this upward sloping trend line is intact, but this is also somewhat of a form of hesitation. Silver relative to gold. Silver has more industrial uses than gold, and hence this is an economically sensitive and bullish breakout the longer it holds. Similar situation here. Home construction, ITB relative to SPY. This is a bullish breakout, and so far it's holding. Economically sensitive transportation stocks relative to the S&P 500. Mixed bag again, healthy consolidation, bullish breakout here, but we haven't cleared this downward sloping trend line. And from a psychology perspective, we do have somewhat of an inverse head and shoulders pattern, with this being the left shoulder. This would be the head and this would be the right shoulder. If the ratio comes back into this area, it goes back into the indecisive category. This chart and the next chart pretty much sum up the mixed bag state of this market. High beta SPHB relative to SPY. The recent high much lower than the June high in the ratio. And if we trade the chart in front of us, we'll learn something either way. So you can make an argument that this ratio looks a little bit concerning and hesitant. But if we look at the ratio of SPLV, low volatility relative to SPY, this isn't a particularly concerning look. You would expect this ratio to be breaking out in this direction if market participants were really concerned. Right now, this looks like a failed bullish breakout. Sideways movement. This is hesitation. And for the most part, this is hesitation. Hesitation, not too bad, but this is a lower high. You can't say that bullish conviction is higher today than it was here. S&P 500 daily DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies, LLC. It's a propulsion target. It's a probabilistic target at 3486. Even if the market was going to pull back, it kind of makes sense for it to move up in this direction to pull more money off the sidelines and then reverse. And if we reversed, the fact that we just negated both the combo and sequential counts on the S&P 500's daily chart, this line here, this is a 913, tells us even if we pull back, it's possible it's just a pullback within the context of an existing uptrend. If you're bearish, you don't want to see this line turn solid. Last week we said it's fair to say that the probability of a pullback was higher last week than it was, let's say, in the previous 6 weeks. That's probably still the case today. We've got somewhat of an indecisive stalled look. An indecisive stalled look could resolve to the upside in the short run or the downside. But in terms of negating the evidence that we've been covering since early April, we really don't have anything to negate that. We have raised some cash and we have nailed down some nice profits. Thus, for clients, it's pretty simple walking forward. If the things that we're concerned about improve, we won't nail down any more profits and we'll let the winners ride. If the concerning charts and ratios and evidence that we've covered in this week's video continues to be concerning or deteriorates further, we are happy to continue to nail down profits. We're not going to make any of those decisions in advance. The market will make those decisions for us. All we have to do is trade the chart in front of us. There's no question that we have evidence in hand that shows increasing bearish conviction relative to bullish conviction. And that basically aligns with the message from last week's video, that the probability of some type of a pullback is higher today than it was a few weeks ago. And if things improve in the coming days and weeks, we can handle that. And if things continue to deteriorate in the coming days, weeks, and months, we can handle that as well, as long as we trade the charts in front of us. And under our approach, the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.